Today, mid-July, we're going to talk about taxes. You talking about taxes? Come on now. In July, yes, new legislation trying to make some changes. It's going to affect everybody. Good news, we've got expert Bill Cass who's going to give us some insight. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. So taxes, why are we talking taxes in the middle of the summer? July, we only talk about that in the spring. Well, because Congress and the Senate are trying to make some changes, sneak them in here on the American public. Now, the good news is I've got Bill Cass from Putnam Investments to give us his insight, which is fantastic. He's been working with insiders in Washington for years. He has a pulse on this. This is important, though, at some point, because right now no one seems to care. We have to talk about these deficits, okay? You've got almost $23 trillion in debt. We're running $1 trillion deficit every year right now with our budget just signed off on it for the next 2 years. I mean, it's a disaster that nobody seems to want to look at. They continue to kick it down the street. Now, that being said, they're going to start going after these dollars. Retirement dollars, dollars passed on to the next generation, changes on estates, you name it. Don't want to give you any more. Let me pass it over to our expert and friend, Bill Cass from Putnam Investments.
All right, taxes, outlook on taxes, okay? You can't see the numbers up here, but here are the, we can certainly, Michael can get this to you, but here are the current tax brackets, and here are the tax brackets before we had the tax law passed. So these are, these are obviously much more favorable, not just at the higher end, and I probably used the same slide last year, but all the way through the rates are lower. Instead of paying 15, you're paying 12 for this slice. Instead of 25, you're paying 22. Instead of 28 or 33, you're paying 24. Okay, so much more favorable tax rates. Now, the one thing is that with these tax rates, under the way the law was passed, they expire after 2025, okay? Or sooner if Congress, you have changes in Congress and that could happen. So let's just say they expire after 2025, and then Congress at that point has to figure out, okay, what are the tax rates going to be going forward? Does anyone think they'll go lower than these? No one. I keep looking, in all my travels, I keep looking for the glasses half full person. It's not even, you have to be glasses overflowing or something to be that optimistic. God bless you. But yeah, I think that's the general gist of it. So I think from a tax planning perspective, these might be the best rates we see in a while. Heck, these might be the best rates I see in my lifetime. I'm 52. I don't know. You look at, and I don't want to bum everybody out, right? I don't want to, but here's a look at the deficit, right? Federal debt held by the public was high coming out of World War II, and you see it spiked through the 2008, 2009 recession, and it sort of remained pretty far up there as a percentage of our overall economic output. Okay, so this, I don't mean to alarm anybody. That's not. I always say we don't need to break the glass in case of emergency at those levels, but it's unsustainable if it keeps inching up higher. And then, we don't want to get to a situation where, it's Greece or even, recently, years ago, Japan was much higher than this. So you don't want to be in that position. You want to be, economically, policymakers in Washington want to have tools in the toolbox. When we do hit the next recession, not if, when, Although Australia's been recession-free for almost 30 years. So whatever the policymakers are doing there, I think everybody should maybe take a look at that. But as far as when you do hit the next recession, you want to have one of the tools in the toolbox is government spending. Infrastructure, something to sort of jumpstart the economy. The problem is if you're carrying a lot of debt, it's hard to layer on more debt to get yourself out of the recession at the same time. So it sort of limits the effectiveness of some of those tools in the toolbox. So, if you look at that and then just government spending, where 71% is basically on autopilot, the 71% sliver is Social Security, unemployment, health care, like Medicaid, interest on the existing debt. That really isn't, that's really on autopilot. That's not controlled in the annual budget discussions every year. So we talk a lot about the federal budget, and can we cut the federal budget, and what can they do on a yearly basis? There's not much you can do unless you're going to pass legislation to affect the 71%. Here's non-defense and defense. That's where they have more specific control over. But to really move the dial, at least on spending, you're going to have to look at the stuff in the blue. And that's really tough. People get really nervous talking about Social Security in those areas. Okay? So what that tells me is that if you're limited on the spending side, then you have to look at the revenue side. And the revenue side is taxes. So again, I think we're in this environment right now where there's very low tax rates, and I think there's certain things you can think about to take advantage of those low tax rates. Okay? So for example, okay, you're taking money out of your IRA. You're taking the required minimum, and that's it. Okay? Maybe, and everyone's situation is uniquely different, but at least think about, does it make sense to take a little bit more at these low tax rates? It might. If you're in these lower tax rates, let's say you're in one of these tax rates down here, how much room do you have before you jump into the next tax rate? And working with your advisor, working with a tax professional, they can sort of tell you, geez, you got $15,000 before we sort of get into the next tax rate. Maybe take some more money out of the IRA. Now, again, I don't mean to say that lightly. I don't mean to say that lightly because you don't want to have a situation where you're taking a lot out. It leads to a big tax bill. It might affect your Medicare Part B premiums. All of that stuff is super, super important. But keep an open mind about it. I think people aren't spending down their IRAs as efficiently as they could. If you look at an IRA, and if you think about passing assets to the next generation, I'm just trying to put the next generation through college. If they get anything after that at this point, I just start. I know you've gone through it, or you're still living through it, Michael. Well, I just,
Someone just said over here, God, you look really old. What happened to you?
Yes. Last year, I think I was here last year, I had not made a tuition payment yet. So I just made a third, for the fall semester. So I'm aging rapidly. Do a before and after of me this year versus me last year, and tuition is certainly a factor. But if you think about legacy planning, what makes sense to leave to the next generation? Maybe an IRA doesn't make much sense because it's fully taxable. And now you're telling me if this legislation goes through, those beneficiaries are going to be forced to take it out and pay a big tax bill at some point on it sooner rather than later. I'm not so sure that's the best asset. Contrast that with passing on, I own a stock. It's not in a retirement plan, and I paid $10 for it, and now it's worth $100 a share. So I've just held on to this thing. It's grown in value. Let's say that I pass away. I leave that to my son. My son gets a benefit, right? What's that benefit? Does anyone? Stepped up basis. It's a beautiful thing. Now, I'm not saying that there couldn't be laws that deal with stepped up basis, but right now, he would inherit my cost basis at $100 a share. All that appreciation at my death would be free of capital gains taxes. So, we sort of think about what makes sense to pass to the next generation. Another one, thinking about being tax smart with IRAs. Hopefully all of you know when you get to be 70.5, you can take money out of your IRA, you can have money sent directly to a charity, and it's tax-free. okay? That's not expiring in a couple years. That's permanent tax law, and unless they change it. I don't see them changing it. It's not controversial at all. In fact, you can do up to $100,000 a year if you want to, and that can include the required minimum. So for those folks that are giving to, philanthropically minded, okay, are giving to charities, by the way, taking the standard deduction, okay? Remember the standard deduction? Go back to what I talked about last year. It basically doubled. So almost everybody's taking the standard deduction now. When you take the standard deduction, you have to give a lot in 1 year to be able to itemize. The standard deduction for a married couple, 65 plus, is $27,000. So, unless you give a lot in 1 year, you're probably going to take the standard deduction. If you take the standard deduction, the check you write to your church for $2,000, you're not going to benefit tax-wise. My wife and I took the standard deduction this past tax year for the first time in 20 years. It was sort of close, but when we bought our first house, we started getting the mortgage interest and all that stuff. But with the limitation of many deductions and the increase in the standard deduction, almost everybody's taking the standard deduction. Less than 10% are itemizing at this point. So just think about that, giving out of the IRA. It's much more tax efficient than writing a check out of your checking account, with taxable money, than give it tax-free out of the IRA. So I think that makes a lot of sense. Again, how do we spend down that IRA in a tax-efficient manner? How do we think about being a little bit smart from a tax perspective? Question? Oh, sorry. I get carried away here. Sorry about that. I'm just going to screw up. Lastly, on the outlook let's shift gears. Let's talk about estate tax. Okay? So on the estate tax front, very favorable right now. Okay? So over your lifetime, you can give away while you're living or leave at your death right now over $11 million of net worth per person. So as a married couple, you don't have to worry about federal estate tax unless you're north of $22 million in net worth. That rules out almost everybody. It rules out me. By the way, if as far as the spectrum of problems, the estate tax, if you have an estate tax problem, that's one of the better or best problems to have. Because it's all things being equal. So what does that mean on the estate tax front? A couple things. Those numbers revert back to the numbers that were in place before the tax law, $5.5 million-ish per person. Still the estate tax won't affect a lot of people. But if you're not going to have to worry about the estate tax, you still need to do estate planning. So I think that's the problem. People think, geez, I'm not close to being, husband and wife, we're not close to being worth more than $22 million with everything added up. Then, okay, we don't have to do estate planning. Everybody needs an estate plan. I probably said the same thing last year. I'll reiterate it. It has nothing to do with the federal estate tax. When's the last time you had documents updated? What if you have a trust and there's any changes in the tax law, you need to go back to your attorney and make sure nothing has to be amended in that trust. Who's going to make decisions for you if you can't make decisions for yourself? So all this stuff we don't like to talk about, but it's super, super, super important. I said it last year too. Think about your retirement accounts. Think about beneficiary designations. Make sure they're updated. A lot of people just sort of are on autopilot and they don't update them. And just make sure they're updated because that's a really easy fix. Just put in a new form, make sure it's there, your provider has it, and then you have nothing to worry about. So a lot of people, the very simple thing to do. And then I go back to, from an estate planning perspective, it's not about avoiding the federal estate tax. It's about, okay, if you are going to leave wealth to the next generation, what assets make sense? I talked about an IRA, maybe not. Fully taxable. Appreciated stock, maybe that makes more sense. Again, there's no definitive answers, but I'm just trying to have you think about it broadly. Because, especially with IRAs, most people are just taking the minimum amount, and they're not at least considering, taking a little bit more, considering the current low tax brackets. Okay? Questions on the tax outlook? And oh, by the way, one of the questions I do get is, okay, the 2020 election, could we see some more, upward pressure on raising taxes? you know, if the Democrats take back the White House, Democrats take back the Senate and hold the House, yeah, you could see some things. I would think at that point they would probably look at the estate tax, bringing that number back down to a lower number. I think what they would at least do is look at the high marginal rates and maybe go back to what the old rates, okay? Biden has said he would do a few things, tax on wealthier families and maybe looking at stepped up cost basis to pay for his health care plan, okay? So there is some pressure there. I would say, at least as we stand here right now, I would say it's a real uphill battle, though, for the Democrats to take back the Senate. They'd have to net 3 seats. So if you just look at the numbers, the Republicans are defending, I think, 22 seats. The Democrats are it's around 12 or 10 or 12 seats. So it looks like that, wow, that's pretty easy to break up 3 if they're defending all these seats, right? The Republicans this time around. But you have to take a step further and look where those seats are. They're heavy, very red, pro-Trump areas or states. So even though they're defending more on the Republican side, there's not as many toss-up opportunities for the Democrats. And the Democrats are defending Alabama, okay, and Colorado and a couple others where they could, you know, it might go the other way, depending on the election. So again, who knows? No crystal ball. But as far as tax, the question I get is, will we see big tax changes before these tax rates expire in 2025? Possibly. But I think at least as we stand here right now, I wouldn't say it's likely after the 2020 election. I think we'll still have a divided Congress. And who knows what's going to happen with the White House.
Thanks so much for watching. Obviously, a lot going on, a lot of information to digest there. Continue to watch our page. We're always doing our best to educate our clients and viewers on what's happening out there, not just on Wall Street, but in Washington and how it affects you and your pocket. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.